Okay. Good evening, ladies and gentlemen. This is Real Estate Trading Frank. This is an advanced coaching session known as ACS. We have for ACS for July 31st, Sunday evening, approximately 7:22, 7:23 p.m. Eastern Standard Time. Session will be recorded and will be accessible to ACS members via the YouTube Real Estate Trading YouTube channel. All you have to do is I'll basically go ahead and put the emails in there so you'll receive a direct notification. And make sure that all of you just put in your email and subscribe to the YouTube channel, Real Estate Trading YouTube channel, so that anytime anything is posted up there, uploaded, then you will be notified automatically and you can listen to it at your own time. Full disclosure, this is purely for financial education and not for any solicitation or advice. We had a terrific advanced coaching session this afternoon with Tim, who's attending again, and with Nav. So they have a little bit of a head start on understanding stuff that we're going to talk about tonight. Jules, I believe this is your first session, correct?
Yes, it is.
One of the things you might want to do at your own time is go into the members area, or of course it's all there on the YouTube channel. Look up and review the introductory sessions, beginners coaching sessions, so you have a basic idea on the basic stuff that I normally go through with new ACS members. I will also make time to work with you and a bunch of other brand new ACS students so that you guys are up to speed with people like Tom Gans and even Corey, who's attended a few of these, so that you guys are up to par. We have C. Bailey, who's joined us right now. And bear with me one second. What's your username? Mr. Bailey?
C Bailey 2406.
Oh, okay. And your first name is?
Charles.
I know Charles, yes, Charles. Charles, you've been a member for what, about 2 months now?
Yes.
Yeah, that's correct. And you are a, I haven't checked yet, but you are a paid ACS member?
Yes.
Okay, terrific. Thank you. All right. So let's kick off tonight's session, and we are going to look at a whole bunch of technical charts, and then I'm going to spend some time, and this session normally overshoots an hour, so we should be done by, I would say by 8:45, if not 9 o'clock. That's what it seems like, it goes once we start to get into the flow. And I'm going to go over a bunch of my charts and, of course, entertain a Q&A session towards the end so that I can address some of the questions that you might have. Stop me anytime, not too often while I'm going through the stuff during my presentation so that no one's left behind as I'm explaining some of this stuff. So fair enough? That's clear?
Yes.
Okay, great. All right. So I just put up a terrific piece that I noticed came out on investing.com, which validates every single thing that I've been talking about since a long time. That is, in simple terms, the majority are bearish, and it's a fact. So the first part of the session, we're going to talk a little bit about the behavioral aspect of what we do, because that, in my opinion, from my personal experience, is the most critical factor. It's the X factor that drives us towards doing what we're doing and being consistent. Not to mention that we won't get hit on certain things at certain times. Saying all that, this particular piece that I put out there has to be read or scanned through, because this gentleman, Urban Carmel, has put together a phenomenal piece which talks about not just a headline number and a paragraph, but he actually puts to some terrific charts, and all through. I looked at it on my iPhone, and I'm a speed reader, so I went through the stuff. But it's pretty fantastic because it gives you actual data and historical fact, statistics, I should say, not facts, statistics and numbers, which are exactly what I talk about all the time. Now, this is not written in stone. All these this type of behavioral pessimism that pervades the market and has been pervading the market, believe it or not, since 2009, even before 2009, but more so from 2009 because that's the start of this leg of the rally. It validates my point that that not only are retail investors out of the game, which they are, but fund managers themselves have extremely large, and these are fund managers and pension fund managers and other institutional money, have extremely large cash positions sitting on the sideline despite a 20% rally in the market from so bottom line is it's all here, and it's worth the good look. I mean, this is the type of article that you want to like look at it like 2 or 3 times, because at one go you might not have the patience to go through everything. But one of the things that he talked about, that he mentioned, is what really matters to us is where is the market going. Well, I mentioned very clearly, and I'll show it to you again tonight, that 2200 is the level, and I said that last week or the week prior, as you all know. And that's exactly what he's talking about. And he's making it simple by saying the SPX consistently reacts negatively as it approaches each round number. And that's why in my ACS sessions, and the older members know very well, I've talked about 100-point trading bands, which roughly on the S&P 500, which translate into roughly 600 to 700 Dow points. And that's the trading band, believe it or not, we just broke out of, which I also forecasted and showed in the form of an ascending triangle, while everyone out there was looking for the next big crash. Corrective pullbacks and mini crashes are mandatory. And we'll talk about that as we move forward, where I call the slingshot routine. You ever use the slingshot, any of you guys?
Yes.
Okay, there you go. So I got one which we bought on a fantastic trip to Maine and northern Maine, close to Canada, and it's a beautiful one. It's handcrafted and all that stuff. So when you look at slingshot and the physics of it, you got to pull it back to build the kinetic energy that moves, that basically shoots the projectile towards wherever you're shooting, right? Same thing with the markets. The markets are physical manifestation of laws of nature mixed in with behavioral, aspects. Charts are basically visual manifestation of human behavior. So the bottom line is that these things might seem simple, but they are, hey fish eyes, but they are very true. And we have to apply all these principles when we are trading, investing, and looking in the markets. And just the way this is the way I do things. Not saying that everyone has to sort of think of it like that, but if you do, it makes it quite simple to understand what's going on, even though it's hard while it's happening. So this number, this round number of 2200 is, when we chart it, technically it's pretty much correct. And I showed that on my previous charts. I'll show it again tonight. So let me move this. And this, by the way, is a great site. I use the app on my iPhone. A lot of the times when I'm not directly at my desk, I post charts from my iPhone, just the candle ones, which are very easy on the eye, and those are done off investing.com. I just look at it, and you can try, and it's very, very it's updated very rapidly, so you get the right numbers, whether it be SPX, ES, E-minis, SPX futures, or all other indices and stuff like that. So feel free to use it. It's investing.com. Some of you might be aware of it. So saying all that, before I get into the charts, the key thing to keep in mind, and this comes to my service, is the service. Our service is very young. It's only 2 years old, 2 years and a couple of months. So we are in a process of evolving, and there will be many fantastic, positive. Bear with me one quick second. Had to wipe my reading glasses. Okay. There will be fantastic advanced features that will be put in place. I'm working with some good developers to do that, and obviously some of these things take time. And the update on the iFly chat was a big plus within the past couple of 2 weeks. We're looking into Slack and all kinds of other fun stuff. The other thing that I believe is a deficiency in my service, I'll be the first one to admit, is the direct accessibility to all previous charts, which Jules had mentioned too. So that is something we're trying to streamline so that on each day, when I do the charts, it'll be uploaded directly there. You can search by symbol, by date, so you can look to see where I was and what I was, what I was forecasting, back then. It's good to see that. And the same thing will apply with Periscope broadcasts and such, which are all put in one place. And keep in mind that you can also put in, when I do the Periscope broadcast, you can follow that. So anytime that I'm doing it, you can automatically see it on your iPhone specifically, and it's very easy. And Twitter has made an adjustment, improvement, where all my Periscope broadcasts, which are intraday short clips, are put there, are listed by date. So I think that's really helpful. You can all find that in one place. So you guys are all familiar with the Periscope streaming, correct?
Yes.
Yeah?
Yes, sir.
Okay. Because it's kind of new to me, and I'm going to be using it a lot more. All right. So saying all that, for now, what we have in hand is important in the sense that the Twitter feed is the main conduit to, and I know I'm reiterating the same stuff, but it's important, is the main conduit for delivering all content. And as you get more used to, once we go through this series of advanced coaching sessions, I can assure you that you will find it hugely beneficial to monitor my work, use your own your own planning and your own forecast, trade management, but you'll be at least maximizing the value that's coming out of my work that I'm putting out there. So let's kick off by looking at, I'm not going to go into the chart patterns and stuff right now, but we did that this morning, and Jules, I'll work with you and a few others on doing that, when all the different chart patterns that come into play, whether they're what do you call, inverted head and shoulders, inverted hammers, which are bearish, reversal hammers, those are bullish, all kinds of stuff. But we'll do that at one other point. You can also look up chart patterns on surinotes.com. That's the gentleman who also posts on StockTwits, and also on just Google technical chart patterns, and there's a lot of them, and you can see the ones which are most commonly show up in the market. I try to keep it simple. So saying all that, the purpose of one of the most important things I have to tell people who are attending this for the first time is one of the most important aspects of my service is that there is no fixed method. I believe in flexibility. There are certain things that have worked for me over the years, and that's the reason why I take the time and the energy to share all those observations and thoughts with people who might find it beneficial, traders who might find it beneficial, traders and investors. So I cannot, during volatile markets, when traders are just looking at price and not trading or looking at the charts, there is no way possible that you'll be able to manage things just by looking at price. Price alone doesn't tell the whole story, especially with the movement of, I should say, the domination of high-frequency trading programs, what I call algo HFT programs, algorithmic high-frequency trading programs, there is no way in the world that one can basically trade effectively and manage effectively in volatile markets. And that's the reason I think a lot of traders get blown out, because there's so many false breakouts and false breakdowns. Even though the overall chart picture might stay positive, intraday the movements in the markets just, and you guys all know that, okay, it just can be completely confusing. And that's where using sophisticated platforms, such as one of the most sophisticated ones that I use, at least in my opinion, which is the Quad Algo HFT platform, that has worked fantastic for me. And I can call shots on the market as to real turnarounds and things like that, both intraday more and intra-week, very, very effectively. And that has obviously benefited and it helped a lot of people. No question about it. So if anyone wants to try the Quad platform out, it's a bit of a learning curve, but it is truly phenomenal in detecting sell programs that are coming in and such, which are also shown on Thinkorswim, and but not as accurately as and fast as it does on that side. And a big fat red candle, when it appears, might look small here, but on the Quad platform it is very visible. And those things can save you a lot of money and stop people from getting wiped out if they're a little too overloaded in the market at any given time. Extremely critical. And saying all that, the final point, which I think is extremely important, you have to have a charting platform that is similar to mine, at least one of them. So if you do not have Thinkorswim, doesn't matter. Get an account. Put $100 in and just, I used Thinkorswim for more than 2 years. I didn't even trade on it. I just used it for charting, and I learned so much from it. I mean, this platform, the TOS platform, is way out there. And I think I use maybe 5% of it to maximize my returns. This is actually for rocket scientists. And there are traders in our group, and I mentioned Harry for a reason, who are very well versed on the scripts and all kinds of stuff on Thinkorswim, and you know, they understand it a lot better. I use it primarily for charting in my drawings, and it works out great. But you need to have one platform, either Thinkorswim or the Quad HFT, or both, if you really want to move on to the next level. But you need to have one which basically mimics the charts that I'm putting out there. I use 4 different platforms, just so all of you are reminded, and Jules mentioning it to you too. I use for fast trading, dynamic trading, I use Thinkorswim. This is this. For the then also for market related, market related movements intraday, or even for swing charts, as you know, whether it be Allergan, whether it be Celgene, or whatever the case may be. I use this coming up right now. Okay, did that appear on everyone's screen? My the SPY chart on the Quad system, on the Algo HFT platform.
Yes.
Okay, good. Because sometimes it takes a few seconds for your screens to refresh as I'm pulling in things in here. So keep that in mind. So so this is the second one that I use, the second platform, which I highly recommend to people. And anyone who wants any information, just let me know. I'll just email you out the link. There's a whole bunch of stuff in there. Then you can talk to directly with them. It costs roughly about $120 a month, and it pays me back 100 times more. I pay a lot more for that platform because I use it. I have the whole comprehensive package. There's a streamlined package that I had told the gentleman, he knows me because I've been using it for many, many years, the founder of the company, and he has agreed to go ahead and lower the cost down to 120 instead of 400 plus that I pay every month. So that it's a huge discount, and it works very well. And The third one is, which is not necessarily used for fast trading, but certainly, things pop up here, which I can clearly see, is freestockcharts.com. That's part of Warden. You can pay. I use the free version. You can use the paid version if you want, but the free version works fine with me. The only things that delayed on this, and I don't use it for real-time basis, meaning real-time SPX, RUTs, and indices, I think is delayed by a few minutes, is but otherwise it fills in nicely. I mean, it refreshes fast. So this is another one that you can use free. Freestockcharts.com. Can't get any easier than that. The fourth one that you see time to time, and I haven't used it lately, is a very clean version. Fish Eyes loves it, and is tradingview.com. Okay, tradingview.com. And second. There we go. Now, I haven't drawn anything on it because I'm not signed into my account right now on this. This also has a paid version, but I use the free version. So it's all up to you what you want to do. And this one also is very clean on the eye. It's very simple. It's almost, it looks very similar to what I see on my iPhone when I look at the charts using investing.com. It looks like it's the same Java-based platform and whatever script that they use. And you can clearly see here what it looks like. And I've when I sign into my stuff, you'll see all the different lines and everything that's drawn on top of that. Saying all that, and now we're going to enter into the actual technical part of the session. One second. There we go. I want to remind people of a couple of very simple but important observations, or I should say pointers. Charts alone don't make you money. That's a given. All right. If charts alone made money, then every so-called technical analyst would be, making $1 million a week. It doesn't work like that. Charts are simply tools that, visual tools that we are using, and the movement, the volatility movements that we see because of these high-frequency trading programs that are in the market every single minute skew things big time. That's the reason I would say that's the primary reason why so many brilliant minds couldn't have called this market. Now, I'm not saying I called this market to the teeth, but I called it as accurately and precisely as possible, and the markets went. One second, you have to mute your. Tim, can you mute your mic?
Sorry.
Yes, thanks. Okay, that's good. So bottom line is that I've been very accurate on my predictions, and I was talking earlier on today, and I was mentioning when I was talking about this ascending triangle, it was funny because I review a lot of different charts, right? I look at a lot of the smart minds on StockTwits, and there's some brilliant chartists out there, okay? But I didn't really see anybody really like looking at a pattern which was so visible. This pattern I'm talking about, this one. This is an ascending triangle, a large one, that it was going, and then it went, and that was a big breakout. That was a big breakout back in July 8. It's always 8, right? The number 8. And now here we are in a nice bullish consolidation channel, which we're going to go over and see. I've already shown that many times, but we're going to go over it tonight too. Where it's going. So my thesis is, and this I've seen happen year over year, is that there is such a heavy cognitive bias towards charting, meaning everyone's just so shell-shocked, majority. Either they're all trying to be central bankers in the middle of trading Google options, or they're all trying to do think too hard, or whatever they're doing. It's analysis paralysis, plus their cognitive bias that that everything is so terrible that markets can only crash and never come up, has put them in the doghouse. No question about it. The numbers speak for themselves. Now, this happens to individual traders. This happens to hedge fund guys who were underperforming the market by almost 800 basis points, like 8% or so, till earlier on this year. And then they started to catch up. And it happens to mutual fund guys. It happens to a lot of people. There seems to be a broad cognitive bias, and that's where the pessimism factor comes in, and that's why it's important that everyone read that article too, that so much cash is left on the sidelines, because every time the market goes up a couple of hundred points, you hear the same old chorus, here comes the big one. Well, the only big one that's happened, and we're looking at recent memory, since the crash in Brexit, has been the unwind of the big short, which I've mentioned several times. The big short that was put in place by the Soroses of the world and the Druckenmillers and Jeff Gundlach and the little squeaky Bill Gross, okay, who's the worst stock picker in the world, by the way, and market caller. I'll be honest with you on that. So they basically they started covering. No one. I've not seen one single statement out there, aside from me mouthing off, that this big, huge monster move that had shown the probability of this happening as reasonably, moderately high, and I was right, got confirmed in a big way, that this massive move, this was Brexit. And then you had this big V-shaped turn, minor consolidation channel, profit taking. That's basically what it is. These consolidation channels in the framework of a large inverted head and shoulder, where you have the left shoulder here, the right shoulder here, the head down here, the neckline up here, and then the pivotal breakout on July 8th, continuation of a bull flag. This is actually a bull flag. Possible upside towards the 2200 area. But I never saw anybody talking about the fact that this whole, excuse my French, frigging rally happened on the backs, not of mom and pop, who are not trading stocks, but a significant amount of large macro global funds who were short the market and finally got a break. But that break lasted 48 hours when the market dropped 1,000 points or 976 points, if I'm correct, within a matter of 48 hours. So I didn't see anywhere written that those guys were the ones who started off the first leg. And if you look on the daily, there are 3 fat candles that went up like this, starting off on Tuesday morning, Tuesday afternoon. Brexit happened on Friday. We went down Friday, Thursday night, Friday. We went down Monday. And I said it, Monday was going to be, we need to go down Monday. It needs to flush out. And then Tuesday, I believe we were down at the open, and then we took off. So the point is, when the elephants start to cover, that's the unwind of the big short, because they were the big short. And there was an interview given, and I posted that too, by George Soros, day after Brexit, and the tone of his voice was, he's going long. And you don't hear Soros going long. He's either just gold or short. But he, in his statement somewhere, he talked about the fact that he will be supporting the European markets, or he doesn't want to see the complete a complete demolition derby on the European markets. That said it all. I'm not saying he's a single player, but believe me, people follow him. So this big move that happened was all because of that. This is the unwinding of the big short, and which is still continuing, and we have a little bit more room to go, in my opinion. That's it.
Hey, Clue, one thought. Did you see Goodluck come out and really blasted the market this weekend too?
Yeah, I did. Jeffrey, yeah, he could sell everything. Great. I will sell everything when it reaches my point. We're not too far away from making a serious top. 2200, in my opinion, we're getting there. No, but it doesn't mean it's going to hit 2200 and just, whoops, gone. No, it's going to overshoot. Probably 2250. Don't even rule out 2300. I'll show it on the charts. And so Gunlack saying sell everything, I don't know, man. And Gunlack himself is very smart, but don't forget one thing, guys. Everyone talks their book. He obviously went short somewhere in here, and now he's getting hurt. Okay? He's getting hurt. So he's going to scare people. He's the master of manipulation. Believe me when I tell you. Carl Icahn is the master of manipulation too, but he's more idiotic when he talks. Gunlack is very smart. He'll do a presentation with 20 slides as he does, and he'll basically convince you that you're finished, and you'll shoot yourself. Okay? Jeff Gunlack is a master of manipulation. I've been to events where he's been there. He is a smooth operator. Carl Icahn is just, he doesn't even know where his money is. He's got so much money. Okay? So different types of guys, but they're master manipulators. Everyone is. We all like to talk our book. So let's not just blame others. But those guys purposely at times will come out with statements so that this feeling of fear creeps in. Okay? Feeling of fear creeps in because everything is psychosomatic, right? You think, your brain tells you, and then your body acts. Same thing with stock markets. Remember that. If you start to get scared, which most people are still scared, so I know, scared money never wins. And that's the reason most traders are not making money because they're flipping out on every every tick on the market. Look at us. I'm not going to put myself in the picture. Right? I like to keep a very steady hand. So on this one, I'm not joining many of you who get scared on every little tick in the market. And there's nothing wrong with that because the volatility algos are designed to scare you. How many times when the charts were how many times have people heard me say upside intact, charts intact, while people are flipping out because the Alligans of the world are moving up $1, $2, $3, boom, falls 4. Chart pattern never changed. So disciplined traders made money. And the ones who are just looking at prices and flipping out never enjoyed that beautiful rise from the 200 level up to 253 plus, where I called it. Look up my charts. In fact, Allergan has move up to 275. And even then, it's way off their highs. So that's what I'm saying. So let's move on to some forecasting as to what I think might go on this week. Mixed signals across the board, all right? And I'm going to show on TOS first. Actually, I'm going to show here first on this one. Great for swing trading and forecasting. So let's take a look at the major indicators that I use. I use the stochastics. I think I use it very efficiently. I use the vortex indicator primarily for trend analysis. And remember, technical analysis is not 100% foolproof. It's your cognitive bias, like I've repeated many times and explained tonight. It's how your brain looks at things. It's also different formations where it might not. It's obvious, but doesn't do it because there's certain divergences going on. Positive divergences or negative divergences on the internals versus the price. Just keep in mind, do not happen in one day. It always takes 48 to 72 hours to develop. So when you start to see a negative divergence, for example, on the STOs, where the STOs are starting to come down, but the market is still moving higher, it doesn't mean that the market is not going to, the market will reset, but it's not going to do it exactly as this is happening. If this is a negative divergence and this market was, let's say, one second, show you this. This is not a good case of negative divergence here, but because these are all correlated. Oversold, markets hits the lower level. But there are many cases where you start to see, okay, here is one. So you had this cross down, but the market went up for the next 2 days, which is 48 hours. There, you have a cross out here. Nope, that seemed to match. Trying to find one where I can show you a negative divergence. I normally put them on my charts so for people to see. But whatever the case, let's say, this is starting to roll over, but the market still moves on for another day or two. That's fine. Divergences don't have to happen immediately. It doesn't have to follow the internals immediately. It can have a lag period. And that's where traders get totally whacked out because they can't figure out, technical traders can't figure out why it's not happening when it's about to happen. So, so a little patience and discipline is needed. And those are the times I, again, suggest, remember, I'm not here to advise, I'm here to suggest. You guys can do whatever you want with that information. I basically start to roll out and minimize my high beta trading positions because it is only imperative and disciplined on my part to do that. You make a real decent sum of money on some big time moves that I called. Why bother giving it all back to the market? And some people do it, and that's terrible because all it does, it screws with your brain, and then all your following trades get messy. So the vortex indicator, I use that. I also used to use quite a bit, not as much, is the MACD, but I use my own version of MACD with the OBV, with the on-balance volume, with the RSI put in place. So let me explain this particular indicator to you guys. And it can give you some nice predictive moves on what might happen. So let's look at the daily. Okay. I'm going to change this color so it doesn't put it like that. Okay, that's better. Bingo. So let's look at this. Let me make it bigger so everyone can see it. There you go. All right. So the first thing that stands out is the OBV, on balance volume. Always use Investopedia for actual definitions of particular indicators or anything to do with trading or finance, all right? Investopedia. So want a real definition of the proper technical definition of on balance volume, please feel free to go there and read it. To me, on balance volume is basically the net volume, buying minus selling. So on balance volume, this particular line moving up from the Brexit lows is telling you that some serious short covering and new money, active fund managers are now participating in the market to a certain degree, even though cash levels are severely high. It's still lower than what it was in February. So the point is that this is definitely a bullish sign. It's getting up there, but it's very bullish. Look at the pattern of this particular OBV. I call it the Texas bullhorn pattern. It's actually just I made that term up, but honestly, it does look like a Texas bullhorn. And you got and you have it's an inverted head and shoulder. That's all it is. You can even see patterns in indicators. So the bottom line is that 1 second. Hi, Exita.
Hey, how are you?
Good, thank you. So good. So anyway, so we're going to continue. So we have a inverted head and shoulder. You can see that in indicators too, especially on these type of ones, the line ones. And now we're here. This last surge that we saw was the money, the infusion of some serious dollars that went into the market, active fund managers, as they bought up things towards the latter part of the month, going into the earnings season. And that's where you saw the movements in many stocks, because the breadth in the market is extremely broad-based and strong. No one can deny that. So when breadth weakens, that's when you start to weaken. But the breadth in the market across all sectors, some sectors more than others, obviously, has been extremely strong. powerful. So this move up here, just by visually, you don't need to look at the numbers, visually is showing that the first injection of capital was extremely strong. So on a daily basis, the way I surmise it is that there's going to be a pause, because you can't keep on injecting capital into the market at the same rate before taking a mild pause. So this is definitely powerful, but it's up there, because by the time normally that it gets up here, okay, you are getting into some pretty severe overbought conditions in the market. You can see that many times. What I like is the fact that that validates my point that the last couple of times please follow this line, and you can see here the OBV was running at a pace of about 2 million. And that's not $2 million, it's just the OBV of 2 million. It's but then we have now broken above. If you look at it from a technical perspective, we're broken above. It's a breakout. Look at that. There's your last highest OBV that was back on April 27, and then now. So that's a plus. Let's move on. So the first thing that catches my eye is the on-balance volume. Then what I do is I put a Bollinger Band on top, of, I hope this isn't, okay. Sometimes this particular thing, freestockcharts.com, this doesn't operate on most browsers, just so you know that. I use Mozilla on this one, and it supports that. I don't believe Google Chrome supports Silverlight. That's the software, that's the sort of software behind whatever it is. Instead of Java, they use Silverlight. So let me explain this very quickly. You have the buying pressure just ratcheting, right? As the market ratcheted here from Brexit, because imagine as a blood pressure, right? So that's basically what BP is, buying pressure, so, or selling pressure. I mean, Brexit basically caused some serious low blood pressure. I mean, the patient was almost dead, and then it comes to life. So you start to see the candles get smaller and smaller, and then bang. So now, as the market is consolidating at this level, creating a bull flag, look what's happening. This, ladies and gentlemen, is a negative divergence. This is a negative divergence because the MACD histograms are declining, yet the market is steadily creeping higher within a very tight range. Individual stocks, forget about it. That's a different story. They're doing what they're doing, right? In fact, the market is behaving like a stock market and has been behaving like a stock market for many months now. In other words, not everything is moving at one go. Some sectors remain pressured. Biotech was pressured till it broke out, which I showed weeks ago that it was going to happen. It happened. The IBB closed at 289. I'd shown on my charts 290 there. So anyway, so you have a loss in not momentum. The overall buying pressure is histograms. The MACD histograms are starting to decline. OBV is shooting up, so that's good. But so this is starting to come down, and you can see if you squint your eye, and I'm looking at the larger screen here, you can see a little red dot appear. In other words, the histograms are going negative. Right there. See that? So the first thing that comes to mind for the average trader or average technical chart is, oh my God, now we're going to go straight down and this market is going to collapse. Well, over the short run, and we're going to get that towards the latter part of the session, I'll tell you that generally the first 5 trading days, and it's a fact, and I've shown this repeatedly, the first 5 to 7, call it 5 trading days, is when it is mandatory for large pension funds and some mutual funds to put fresh cash in the market. Especially pension funds who have monies coming in are not going to be sitting on that cash pile. They're obligated by their charter, and most mutual funds, as you know, almost all of them, other than a few, are all long only. So the cash kitty has to be deployed. Not all of it. They keep a lot of cash in the money market funds for redemptions. And if all of you have mutual funds know that. So bottom line is that they put money, fresh money into the market. So even if you get a minor pullback on the first part, let's say on Monday or so, it generally tends to get soaked up. And the first couple of days going into the latter part of the week, this just happens to be August 1st, just happens to fall exactly on Monday. So I believe this is going to be somewhat of a bullish week as we go in overall. But there'll be, heavy choppiness, obviously, within the markets intraday. No question about it. We have a lot of earnings coming out. So markets will hit a road bump, and you can write it down, middle of the month, give or take the 15th. Now, the 15th of I'm looking at the calendar on the top, the 15th of August happens to be a Monday, okay? 12th is a Friday, and then 16, 17. That week, give or take a couple of days, plus minus, let's say 3 days, all right? Or from the 15th, you're going to see some real heavy-duty turbulence in the market. It's going to happen. It'll be some sort of event. It'll be some sort of macro, economic type of event, all kinds of stuff. We'll look at it, if we have time, we'll look at the economic calendar and see what's on or about the 15th. But generally on or about the 15th, you always see major turbulence. It's a reset. So I'm not saying we're going to just rally starting Monday all the way through the 15th. All I'm simply saying that for long bias traders, generally speaking, if they're trying to understand the markets, which control the stocks that they're trading in, the first week is generally bullish. The second week starts to get mixed, and it gets really messy between the 11th and 17th. And how many trading days are there between the 11th and 17th? 1, 2, 3, 4, 5 trading days, because in between is the weekend. Am I clear on that?
Yes.
Okay. I'm sure everyone heard that. So middle of the month is when things are going to get nasty. And can tell you, one step at a time, can tell you how August will end. It's way too early, but there's stuff going on that's going to shake the markets up. Maybe a little too. There could be excessive short-term optimism, which is starting to show up, even though overall majority are bearish and pessimistic. The short-term optimism building up. It's always a lot of traders, a lot of amateur traders and professional traders. They tend to come in at the latter end of a major move. We are just around the corner from 2200. So all these things match in. So when somebody says, all right, so is it going to be just a complete free fallout on the daily? Well, this is the way I read it, and I've been accurate before, so I'll stick to it. Bear with me 1 second. So I put the low, when I draw my charts, I always have some sort of Bollinger Band or acceleration band, which is basically the trading envelope. Why? Very simple. I'd like to, in a quick visual, see where the market or the price of that asset or the value of that indicator is trading within the context of that band. There is the band, and there we are right now, a red histogram developing. Okay, if you just simply look at the face value of the pattern, it would be logical to assume that we are going to go into a reset where the depth of these histograms will mimic the height of these green ones. But here's the catch. You have to use the Bollinger Bands, and it's right there at the lower end of the Bollinger. Unless these Bollinger Bands turn around, the market drop will be capped once the first or second red bar appears. And from that point, it's probably going to move up a bit. I don't know if it's going to move up all the way here. I can't tell that far, because that was some serious move from Brexit, which was this acceleration of these histograms. But at this point, just to clear out the charts and explain to everyone, I don't want to spend way too much time on it. It looks like the downward bias on the MACD histograms will be capped pretty much at this level, unless the histogram, this dotted line, turns down, in which case it's going to be a free fall. Okay, does everyone understand that part?
Yes.
Okay,
Yes.
so that's one way. The one way you can tell if you're looking to see like what the markets are going to be doing. Of course, I'll be watching. Saying all that, on this particular chart, so you have the RSI got to 90, simple stuff. You know, RSI got overbought, and it's starting to move down a little bit. Nothing crazy. The RSI here got to almost 100, and then even though the RSI collapsed all the way down to this line here. I'm sorry, that's the my apologies. That's the MACD band. Okay, sorry. The RSI is this pink one. Okay, here, right there, this line. So the RSI hit the upper end of the band, and now we're starting to ease back a little bit. Keep in mind that the RSI hit pretty high levels back in April too, and then went went down to zero. But look at the market. The market still continued after a minor pullback, still continued higher. But that by that time, it actually, the market, no, I apologize, it actually correlated with the RSI big time, because right there is when the market bottomed in April, early April, and RSI also bottomed at that time at zero. But when the RSI was pulling back sharply down, the market did have a corrective action and fell roughly about 300 points here, or 200 points right there. Okay, I don't want to delve into this too much, then we're all going to start getting bored. So the MACD is for now on the lower end of the band, so I expect to see this turning higher unless the Bollinger comes down, in which case the MACD is going to fall apart, and the market will have a nice fat correction. We'll see. We'll see. I'll be watching this very carefully. I use the vortex indicator too on the daily. It's telling you, as you can see here, there is this is a negative divergence here. Look. The vortex hit 145. The market hit here. The market is still climbed higher slightly because it's in a tight trading band, but the vortex indicator is still on a downward sloping path. Market is still here, but the vortex indicator is still on a downward sloping path. So two ways to look at it. This is where cognitive bias comes in, how we look at things. Somebody will say, whoa, the good old bad vortex, okay, how about calling it that, is starting to creep up. And if we see a crossover, when you see a crossover, it's not necessarily good. Because a crossover of the bad vortex over the green one, the good one, means that there is some extended pain to come. Extended doesn't mean weeks or months. On this particular, we're looking at days. So that, I think, is something that has to be monitored carefully, and could be, this most probably is starting to come down at this, what a lot of the times what it does, if somebody does use vortex indexes, VI, vortex indicators, the VI, a lot of the times it'll come down, kiss, and then the green line will shoot up and the red line will come down again and create a double bottom. That at that point, it is almost a given that the markets will pull back. I believe this time the same thing will happen by the time we get towards mid-August. This will come down here, maybe a little bit more, or maybe turn from here. This will basically kiss that and move down again, creating a powerful double bottom. You can use technical setups on indicators too. I do it. So, and then it makes a heavy-duty move, and this vortex basically makes a heavy-duty move down. So this is the plus, and this is the minus. So you know what happens to the market. The market will take a nice little dive towards the bottom end of the channel, possibly retest the upwardly rising 34 and the 50-day moving average, stuff that I've talked about repeatedly, and I think that this is the pattern that it's going to follow. Let's move down. Now, I'm not giving all these somewhat of detailed explanation on this thing to make you all like major technical analysts. Some of you probably are better than I am, but I'm only doing this so that when you see these things on my charts, that you'll understand why I'm putting it there. Is that understood? Yes?
Yes.
Okay.
Yes.
Everyone else? All right. So is it just that you can maximize the information that's coming out of the charts and you don't get confused as to what's going on? Now, looking at the stochastics here on the daily, As we know, it's been overextended over the 80 level, closed at 79.88. Unless we see a total, and these are the slow stochastics, by the way. On these are the slow stochastics. Fast stochastics have already reset on my other platforms, on the Algo HFT platform and on TOS. So saying all that, let's see here. This one, when you start to see it pulling one of these and falling below the 79 level or 72 level, let's say, or you can just visually see, you don't have to look at the numbers per se. You start to see this type of accelerating downward move, you know we're going to get multi-day pullbacks. Always the same story. Look here. Started and then just started to go down. Now, it's not a guarantee. There are no guarantees. There are no certainties in the market. As I always like to say, it's a game of probabilities, not a game of certainties. That's the only thing true about the market. That's the only guarantee. It's a game of probabilities, not a game of trading or investing, a game of certainties. So we don't know yet, but if the strength continues, we are going to try to remain above that 79.80 level, stay overbought like we have been. So there's no way to tell if this is going to do a full scale type of 300-point reset, but I can assure you that will happen. Can somebody tell me when it's going to happen?
15th.
Huh?
15th.
On or about the 15th, not the 15th, on or about the 15th, around the middle of the month. How about that? This will happen. All right. So you have to be tread cautiously, but also aggressively on individual trades you're doing. Individual trades, some of these stocks, they don't give a hoot about resets on the S&P 500. And each indices is different. We're looking at the SPX. We're going to look at the IBB next, and then we're going to look at the Russell. And you'll see the difference. SPX might be hitting new highs, but not the Russell 2000, and not the IBB, not the biotech index. So bottom line is that, and the Russell 2000 is full of mid-size and small, I would say smaller size biotech stocks. It's not just moving on fun, and then of course it's got a whole bunch of gold and mining stocks. That's why the RUT is the play here. It's a proxy to play the gold market. The proxy index. Anyway, so saying all that, it is so. This is really clear as day. This needs to come down and start a trend reversal before we capture this ground that I've talked about and what I'm going to talk about right now. When I draw these charts, I use certain basic indicators. I explained this earlier. I'll do it again. I use the acceleration band. I use the Bollinger Bands. Why? Very simple. As I explained earlier, I want to see where I stand within a large sort of trading band. So the upper end of this band, is 2200 roughly. It's very clear as day. Lower end of the band happens to be at the inflection point of the 34 and the 50, slightly below that, around, let's say I call it 2100, 100 points, right? 100 points. Markets love round numbers. We are going to test 2100. Will it happen by mid-April? I mean, mid-August? Can happen. Absolutely can happen. And that's going to shake out a lot of froth and also to throw a lot of the babies with the bathwater, because everyone's going to freak out again. So the 100, this is 100 handles on the E-minis or on the S&P, 100 points, SPX. Now, does it have to happen? No, because for people like Jules and stuff who are attending this for the first time, and I'll talk about this, on my other session I'll do with you guys, for the newer people, which I did one this afternoon, is that the moving average is simply like highways, right? So the more you deviate away from the main highway, the more you're getting overbought or oversold. As simple as that. We crashed through Brexit, and the highways never even changed. When you start to see the real moving averages starting to turn down, especially on longer term charts like the dailies and the weeklies, that's when you start to worry. That's when you start to worry. But if you look at the highways that the market's traveling in, it's pretty clear that it wants to go higher. However, we have deviated now, and this level here from where we are from the highway is probably 3 to 4 standard deviation, +3 or +4 SD, standard deviation, distance traveled from the moving average. Here, despite the drop in the Brexit, this was like a -3 on the standard deviation. Many of you heard me talk about this a long time. So the bottom line is that as we push forward here, by the time we get to 2200, if we get there, we don't know yet. This is certainly a bull flag. There's no question about it. So straightforward technical analysis would say that we're going to break out and get towards 2190 and then overshoot to 2200. That's the straightforward logic. Will it happen? I have no idea. Even though the pattern suggests it will happen. And this week alone, with a bunch of big shot numbers coming out, it could very well happen. Because overall earnings, more than 60% of companies have delivered stronger earnings than the consensus. So saying all that, this movement here for a pure disciplined technical analyst says, you know what? Yes, I'm going to trade, but I'm not going to go heavy into the market because the market has to reset. I showed you the reset down here that's going to happen on the stochastics. And here, it doesn't always have to come and retest the 34 and the 50. It doesn't have to do that. However, it's preferable it does that, because not only do we, if we catch that trade right, you're going to make some serious money. A 500-point drop in the market, SPX puts will go from, let's say, $4 to 32. I've shown this repeatedly. Some of you are new on the SPX game, your heads will spin. I don't anyone please don't be offended. I call it financial pornography. Okay? You see calls that were $2, go to 30. You see calls that were $4, go to 40. I'm not kidding you. And you just cannot believe like something like that can happen. Is it easy to catch those type of things? No. But the real discipline of effective trade management is the reason why you're taking these sessions. So you can understand and apply it to your own method of how you deal with your own trades. I can't help you with that. That's something you got to do on your own. But the move from here to the reversion of the mean to test the 34 and the 50, get things a little bit cooled off, cut the froth out from the top, would generate those type of returns, 1000% type of returns. Pretty big. But to time it to exact perfection, the market's going to chop you up. Just the way leaving puts out there the other day, you know, even the small amount, chop, 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 didn't work. Because of the bull trend, I mean, the uptrend is intact for now. But there won't be like one sudden event. Yeah, sometimes you see that. Sometimes like on Thursday when I saw that naked bar spinning top and I started to get cautious, it worked for a bit. But then it hit those other lower channels and then bounced from there big time. And now when I look at my SPY chart, I don't see on the daily, on my other screens I'm looking at, on the algo charts, I don't see that infamous spinning top naked bar. Even though it certainly was the case as was detected, just so you know, on that moment. And I showed it. I wasn't just making it up. But those type of things, when you see them happen on weekly charts, and let's see what's happening on the weekly charts. Before I move there, is it clear everything I've explained so far? Because I like to keep things simple, you know. There's no reason to get fully complicated. So at this point, this picture is a good picture. We got an upper Bollinger movement. You can see that right there. You got the acceleration band, which generally stays outside the Bollinger. In this case, it is inside the Bollinger. Look at the green line. It's inside the Bollinger. Don't ask me why. So bottom line is that you got a consolidation channel, which has been showing. If you simply draw a fat crayon over this, there's your market. Futures are up about 350 right now, means nothing. Okay, because everything could change in like 20 minutes or well, you know, in the next 10 hours. So that's where you get to, generally speaking. Now, is it possible that we just suddenly drop out of this consolidation channel? Absolutely. That's why I keep on telling people that the lower end of the scale is somewhere around 2150. And if you fall below 2150, I've shown this repeatedly on my charts, as you all know, fall below 2150, there's a good probability, it's a game of probabilities, right? There's a good probability you're going to correct quickly down to this big breakout level, which is very visible here. This is where we broke out. Does anyone remember where we broke out? Roughly around what price on the S&P? 2120. 2120. It also happens to be where the upwardly rising 34 moving average is heading to. The real line in the sand for this market is 2120. Once we break 2120, all hell's going to break loose. They are going to get so scared. There's going to be stops triggered, everyone freaking out. You can't turn the TV on again without all the idiots on CNBC saying that's it, Armageddon, the Mayans are landing. And the next thing you know, that'll psychologically push the market lower to test the 200-day moving average, possibly around 2082. There'll be different stops along the way. But break of 2120 would not be considered a positive development. And at this point, break of 2150 over the short term would not be considered a positive development. So 2150 to where we closed at 2173. Can somebody give me a rough idea how many Dow points is that? Because I've explained that many, many times. One S&P point is roughly how many Dow points?
7.
Yeah, exactly. 6 or 7. Correct. All right, let's call it 7. So one S&P point, I'm going to put S, is 7 Dow points. So if we fall 23 Dow S&P point, 161, right? That's what it comes to?
Yes.
Okay. So that would be your normal corrective pullback. That will be your normal corrective pullback from 2073 to this support, because this line is an upwardly sloping line, but then also at the same time you can draw this kind of hand drawing it, because that's exactly the point. See that? There you go. 2160. Yeah, 20. You can, if you want to be careful, like 2160 also. That's 100, roughly 100 points, right? About 100 points. So anything below 100 to 161 points, boom. You're going to see some fat stops get triggered, and the market's going to hit the 2120 level. Now, what has been happening in this market, the real story, is that every pullback is being bought. And these patterns have been extremely forceful on the upside. It's frustrating sometimes, to be honest with you, when you're trying to short the S&P, because technical pictures, it gets so frustrating. You're losing money, you just can't make money on the short side, and that's what you hear all the time from the dogmatic and the permanent bears. But you're also hearing that from tactical bears like me at times, because I'd like the market to lose some steam for a bit, but it doesn't work. That's because there are so many shorts. There's big. Somebody mute the thing. I'm hearing my voice echo back. Okay, thank you. So it's please, can somebody mute the microphone? Yes. Yeah. Okay, that's better. So that's just something you got to deal with. But don't get over enthused with this market. I'll tell you right now, because there is a level of euphoria I'm seeing across the board. Even though the bulls are doing talking their the bulls are starting to be more vocal, they're talking the talk, but they're not walking the walk, because every one of us are trading pretty cautiously, not as aggressively as we'd like to, given the chart setups that are in place. Do you all agree with me?
Yes.
Anyone disagree and say, no, I'm trading very aggressively now, I'm sure the market's going higher? Is anyone like thinking like that? Like, not just thinking like that, but acting like that. See, there's a fundamental difference between talking the talk and walking the walk, right? So I know I'm not. My sizes are more moderate. I'm not even going crazy. I seldom buy any sort of major options ahead of earnings. I do the common. And if I do buy an option, I'll buy deep in the money. It costs a lot, not to the size I'd like to. So we are all cautious, which is a good thing. But because at one point will come, I don't think it'll come for a long time, where people are going to get really happy with the stock market. I think it's going to be a while before that happens. It'll be a while. Yet the market will keep on staggering higher. And that article that I discussed earlier on, everyone should read that very carefully because he explains it in fantastic terms, much better than I'm explaining it. So anyway, this is where we are right now. Now let's take a look at the weekly. Okay, the weekly, I didn't notice this. I'm seeing this for the first time. Looks like there is it's almost a green, almost green, but not there, right? That's it. That is a reversal hammer. Does everyone see that? That's a reversal hammer right there. There you go. There you go. Can everyone see that?
Yes.
Exactly. That's a reversal hammer. Some people will call it a doji. A doji is where you have indecision. Indecision. This is a doji, but it's more in the middle. This one is more like a reversal hammer. Should be green. So where is this heading if it goes? It's heading to the same level that I keep on showing. Somewhere between 21 short term, I mean, somewhere in here. And an overshoot will bring you up to 2200. Because once it breaks out of this bull flag, it has to overshoot. That's standard procedure. Because at that point, the real hardcore shorts are like, that's it, I can't take the pain anymore. They cover, new buyers come in, and they say, wow, now the market wants to go a lot higher. At that point, you start to sell hard, in my opinion. You start to phase out. You look for shorts. Even though it might not work right away, it's coming for reasons that I just explained. Because by that time, the distance traveled between the standard deviation on the weekly. 1 second. The standard, this lock again, God. The standard deviation on the weekly is extreme. And you can see that happening. That was a big reversal hammer off the 1990 level, right? Look at this. That standard deviation looks like it could be a +4 or 5. That's a lot. That's a lot. So when you get to that level, you get a pullback. Now, pullback doesn't mean the market's going to crash and burn down to 2000. The pullback means that you will create a consolidation channel, which freaks out every trader that I know, even though I try so hard to get people to stay cool. A consolidation channel is simply where the profits are consolidating. There's nothing wrong with it. In fact, it's also a flag formation, a bull flag formation. Now, whether or not it's a consolidation channel or it's a complete breakdown, no one can tell till you monitor it very closely. And I'm generally very good at these patterns. If you bought here at the last minute and this starts to consolidate, you're feeling like crap. So the bottom line is that two things will possibly happen here. Okay? We have 1 week, 2 weeks, 3 weeks, 4 weeks. Possibly a fifth higher week. If this starts to turn red, then it's going to be a down week. And then you'll have a 6 week. Generally, markets or strong markets will go up 6 weeks in a row. Or 5 weeks in a row and maybe correct on the 6th week. Just week count, standard stuff. So saying all that, you see what's going on with the, this is where we are. Oh, there you are. Good. But I didn't notice that till I just saw it right now. You see something like this, an inverted hammer, please get the heck out of Dodge and short the market. And try to keep a swing short. Okay, when you see an inverted hammer like this. This is a true, when I say weekly, this is a true spinning top naked bar. That's what it's called. All right. So, and that is a inverted hammer. It's very clear as day. And that generally coincides into multiple weeks of pullback. Have we seen that yet? No. If I see it, I'm running out of Dodge and shorting. You got a nice fat return on your money. They won't make it easy, I can assure you that. Look at this inverted hammer back in February. These are the ones you buy like nobody's business. And then you see corresponding, of course, this candle didn't look like that during the day. Why? Because it was down. The markets went up and then fell probably 100 points, right? What's the low of this candle? 1891. High was what? 1963. That's how many points? 70 points. That's 500, almost 450 to 500 Dow points just on this candle alone. Okay, and that was back in March. I'm sorry, back in February, end of February. So you got a 500-point move like that, everyone's freaking out. But the fact is, when you see a reversal candle off an inverted hammer, please stay long, because that's just the way it works. And especially when it's coming off a double bottom. These are real major inflection points. Major inflection points. If Brexit didn't happen, a correction would still have happened, just so you know. Because look, we would have a double bottom. All right. So this was Brexit. This was the Brexit tail, the big short, that they started covering. But even if it didn't happen, it looked like, it was a double bottom, just the way it was a double bottom here. And once you get these double bottom formations, markets tend to go higher. So that's what I'm saying. All right. Now let's move on to toss and look to see, and then I'm going to open up for Q&A. Oh, I wanted to show the Russell. It's Russell 2000. So I'm telling you, I've been saying it from all the way down here. This is one heck of a powerful chart. One heck of a powerful chart. And remember, it's not just the chart. It's what I draw on top of it. Just looking at the chart alone won't give you the whole picture. These trades are real swing trades, guys, okay? And I've been tracking the Russell 2000 all the way from 940. You know that. You get these consolidation channels and breakout. You get a reversal hammer, which looks like it's going to end the world. And it does go down. It tests the big downtrend line from 1300. The big downtrend line. And then the 200-day moving average, the white line. Look at this hammer reversal of that. It's hammer after hammer after hammer. Yes, it's getting overbought right now. No question about it. We probably have another 10 to 15 point higher on the Russell 2000 before we see a pullback. After all, this formation is a rising wedge. See? This is a rising wedge. There. This formation. All right? So what does it mean? It means it's going to consolidate. It's going to come down like that. But let's take a look at the swing picture where the Russell 2000 is heading. The Russell 2000 looks like it's heading somewhere at the way I've drawn it. It's heading to somewhere around 1260. So 1220, round off the numbers to 1260. That's 40 points. Try testing out doing some Russell calls and puts. They're cheaper than the S&P. And they really pay the bills. But again, I warn everyone, trading the SPX and the RUTs are like trading futures. They're going to move violently, with you or without you. So don't go overboard on it immediately of the first batch. The first batch is your tester. If it runs up 2 points, like you see, it runs up 2 points in like 2 minutes. It's a simple reason. Markets are always moving up or down, right? Stocks are not always doing that. Stocks sometimes stay stagnant during the day. Yes or no? It's stuck up maybe 60 cents or $1 or $2, not doing much. But markets are always moving. Up 10 points, up 20 points, down 10 points, down 20 points. Even in a tight trading range, the market's still moving within a 50-point level. Yes? Does everyone understand what I just said?
Yes.
Yes.
Other than Corey and Jules. Yes? Everyone else? Good.
Yes.
So the point is that the markets are always moving. So SPX and RUT will, if you catch the right move based on these very, timely charts that I put out there, based on platforms you're using, such as TOS, and hopefully some of you are going to sign up, not through me, obviously, directly with the quad algo HFT. Well, guess what? You will be able to pinpoint that. You don't need me because look, I'm putting out stuff there as quickly as possible. But during real volatile days, it gets tough because I got to make my own few pennies. And then I'm putting out real-time charts. No service does that immediately. And you have to act on it. So you look at your own screens too. And that's part of understanding what I'm showing. So it makes it easier for you to see it. So the bottom line is that this overall is a very powerful picture. And remember, the Russell 2000 going back to the highs, maybe that's the top in the market, right here. There you are. I should draw 1 second. Right there, right? Do it in green. The high was around what was it? Like around 1300. Yeah, let's call it 1300. So is it possible that this whole massive inverted head and shoulder, as everyone can see that, you got a head, you got a left shoulder with a massive reversal hammer, you got a right shoulder, in fact multiple right shoulders, one here, and this was also kind of multiple left shoulders, and then the big breakout. Pattern formation dictates. Watch. It's amazing how these pattern symmetries work. Multiple bottom. Pattern symmetry dictates that we are going to land up at 1300 at one point or another. Will it happen in the month of August? Yeah, well, it can. With a couple of the Regenerons and stuff and the price lines, they're not in the Russell 2000, but a lot of drug stocks are. In sympathy, they're going to move. Maybe a couple of buyouts, right? They're on the table. We're playing some of them, right? So we'll drive the Russell 2000 back to previous highs. Now, once it backs to previous highs, does it automatically mean that it's going to just crash and burn? No. What happens when things keep on hitting previous highs? They break out. They overshoot. So the Russell 2000 could very well get up to 1320, 1330 on an overshoot. So get ready for it. I don't hear too many people talking about it, but I've seen this happen, and the same pictures, somehow is coming into play. Because if you really think about it, for this year, this was January, all right? Before the big drop in January, when the world was ending. The Russell 2000 basically took 7 months. It just broke out. You guys agree? It just broke out for this year. So if it just broke out, why can't it go higher? Think about it. Like they say, no one thinks about what right can happen. Everyone's thinking what wrong can happen. No one thinks about the positives. No one. They can always think about the negatives. It's just the way we are wired as human beings. We're always thinking what bad things can happen. Now, how about sometimes thinking what good can happen? Saying all that, you have all the internals are positive. This is nice. It's okay. This keeps on jamming. I'm sorry. Look at the MACD. It's just gangbusters. See that? Gangbusters. So this is, these are weekly charts. They're not daily 5-minute, 15-minute charts, Once you get towards those levels, you can stay overbought for a couple of weeks. And that's when it could drive the market up higher on the Russell. Let's move on to our favorite biotech index. I drew this chart a while ago, one of my charts. This is exactly what's going on. This is so defined, it's not even funny. You got a rolling quadruple bottom almost. 1, 2, 3, 4, 5. If you want to be specific, it's more like a triple bottom. We talked about patterns this morning. Tim was there. And I'll explain that, Tim. So bottom line is that I'm showing the probabilities of what can happen. Now, a couple of things can happen here. Here, we have had a major resistance. We got to blow through this with fury. If not, it's going to be back to the same old story. Back like that, Because look, the moving averages are simply moving sideways. They do have a crossover here, if you notice, which is a good sign. But they're kind of moving sideways. They need to curl higher. In order for that to happen, you need something called a breadth thrust. Difficult word to pronounce. Breadth thrust. Try doing it a couple of times, get a headache. Okay, so you need a breadth thrust. What that means is a big bang out of the channel, out of this resistance. And it goes straight here to 315, 320. Why? There's a big gap here, but then there's a big gap here. This will be done on the heel of some major earnings that are coming out. Just letting you guys know that. Right, tonight I don't have time, but I'll compile earnings lists way ahead so everyone knows which ones to watch. And then, of course, you have your great ideas too. I'd love to see them, be reminded of those too. I'll take a look at them too. So the Russell 2000, the IBB, in my opinion, is heading towards 350 to complete this very wide, excruciatingly frustrating pattern that all of us have lived through. Right there. I'm not saying it's going to 400. I'm not saying that it can't go to 360. I'm saying there's a high probability of the IBB going to 340. I pushed the IBB and suggested swing options, and this is an answer to your question, Tim, also, on the IBB I'm talking about. When the IBB was when the biotech index was around 255, around this level. That's 30 points on those swing calls. You go check it out and see where they went. You can play them by playing it on a weekly basis and then keep on rolling them out, or you can buy them a month or two out and say, okay, I think it's going to go there. When you buy things month or two out, just so you know, and just my opinion, you're paying up more, you're buying time, but how do I know what the heck's going to happen to the market during that time? So it's not saying that you always have to play the weekly calls and puts. In this case, we're talking about forward-looking higher ups or calls. What I'm basically saying is sometimes think twice before you buy something a month, 2-3 months out, because we have no idea what's going to happen a month from now. Believe me when I tell you. And I'm pretty damn good at what I do. But I'm honest. Technical patterns can change in a heartbeat. In a heartbeat. Now, it doesn't mean we always have to be super cautious and like do everything on a 1-day basis, 2-day basis. But what I'm saying is sometimes don't pay up so much because we don't know what's going to happen in September or in October, even though I predicted very right on a lot of things. So at this point, we need a powerful straight up move, little pullback, and then 320 would be a good bet. So you can look into buying, end of the month 320s. Or wait for a pullback. Because if this fails here, it's going to be back to the other zone, which is roughly between 260 and 270. Telling you that right now. It could either do this and come all the way down. I don't think it's going to come all the way down. Because some powerful ones have come up with earnings that have been good, including Celgene. So the bottom line is that it can happen. It can just come back and test the 50 and 34 and the 50-day moving average. Where is that? That's at 270. So this is a good pullback point. It's going to feel very painful if you're too long biotech, because those are going to be back to the bad days of like 14, 15 point down on the big boy movers. But that's a buying opportunity. Remember, biotech companies, the reason why they're great swings is because they're working on products that take years, correct? So they're
Yes.
a little, yeah, so their whole fundamental nature is different, the way they look at things. They do clinical trials that has to last a year, 6 months, 9 months. They just can't come out there and say, oh, whiz bang, I just came out with the next Pokemon game. Biotech companies have sheer responsibility. That we have the finest biotech. We are the world leader in biotech. Nobody comes close to us in innovation on many different fronts. But in biotech, we're way ahead. There's nobody even close to us with the type of new technologies that are coming out. So it takes time. But that is it. Now, Tim asked the question, what is your trading plan if we expect SPX move to 2200 and Russell 1280 to 1300? Well, like I explained, your trading plan, you can do it two ways. You can keep on rolling out week, 2 weeks out and keeping a close handle on your tight grip on your calls, Or you can say, hey, it really looks like it's going to get there, which I have no idea. I'm just saying there's a higher probability of getting there. Then you can buy out 2 months out. Pay up quite a bit. I wouldn't like that. I don't want to tie up my money for 2 months knowing that we are at a somewhat overbought condition, which I can buy a little bit cheaper. So it depends on your outlook, Tim. Are you looking to, need to watch Hillary? And well, the market knows. The market knows. Yeah, she might make another comment, but believe me, we're off that stage where Hillary's going to, the first time she really rocked the market. But in subsequent times, it's a law of diminishing returns. You know what that means? When you keep on doing something, it starts to lose its power. It's economics law, very simple. Just like QE. Over a period of time, before we stopped QE in October 2015, it had a law of diminishing returns. You can't keep on infusing money in the economy. You have to make fiscal changes, government policy changes. You can't keep on just monetarily just, saying, oh, I'm just going to keep rates low. It doesn't have any effect. I'm going to keep on pushing money into the economy. Over a point of time, it has a law of diminishing returns. So the same thing with the Hillary's comments or any other political comments regarding the markets. All right, so that's it. Now, let's take a quick look at the NASDAQ. I drew this a while ago, and the NASDAQ is going higher. The NASDAQ is going higher. Now, how much higher? It's right here in the charts. It's going to about the upper end of the NASDAQ on a daily basis. It's somewhere around 52.71. That's it. I drew that. These lines are very precise. Look at that. And it touches some major inflection points. So somewhere around 5,300. How about that? We're going 5,300. So that's another swing trade you might want to consider. But like I said, you can't be a jack of all trades and master of none. You can't keep on just putting stuff here, there, everywhere. You need to specialize in something. Given the volatility in the market, given the event-driven market we're going through, and will always be in, I would suggest that you keep things tight, close to the vest, get some nice profits, get out of it. Yeah, you might have missed the last 20% more, but so what? Don't keep very large positions overnight. I'm telling you right now. Have some position because there's a lot of stuff going on. I don't like the way the yen's acting. It's a complete negative divergence. The yen's completely collapsing, and our markets are doing good. There's a complete what's the word I'm looking for? Separation. What's the word I'm looking for?
Bifurcating.
Thank you. Bifurcating. Okay, we're bifurcating. It's a bifurcated market, but more importantly, what I'm looking for, decoupling. That's what I'm looking for. We have decoupled from the yen carry trade, which is very weird. Just so you know that. Because normally with the yen collapsing like it did, I'm going to go that in a quick second, we would be down like 500 points. But it doesn't matter. You know why? Like they say in New York, excuse my French, money talks and shit walks. And it's not just in New York, it's all over the world. That's capitalism. So money is flowing into the market, so stocks are going higher, period. Yen or no yen. You just got to accept some of the small, truisms of life. There are money coming into the market, so they're buying stocks. They're buying good companies. They're not buying everything. There's a lot of red on my screen too on certain days, right? But we try to be selective and play the ones which are on the trading books of the large hedge funds. So again, we are very overbought, no question about it. Looks like a little bit more room to move. I've explained all that good stuff. Now, let's take a look at, and this is actually good. Okay, I drew these charts months ago. Corey, you remember that, right? Corey loves my explanations on these macroeconomic linkages between the yen and the 10-year bond and stuff like that. So I drew this chart a long time ago. And this is something I just noticed here, first time, with a great audience like all of you. And I'm going to explain it for the first time. These are my lines that were drawn. I repeat, weeks ago, if not months ago. Look where the yen is bouncing from. This is fantastic. Okay? This is a double bottom. No question about it. Then we started to go, technically speaking, we should have gone higher and hit the upper end of this range. somewhere around 109. We didn't. We hit this previous top, roughly around there, and then the yen did some serious dumpster diving. That was serious dumpster diving. And this, when we were correlated directly with the, it's not like we're completely decoupled, but if a move like that on the yen where it falls from 105 down to 102 or 101 and change, would have completely decoupled our market. It didn't. That's a positive. Did you guys hear me what I just said? That's a positive, that it didn't happen like that. Now this is the best part. These lines that were drawn, look where the yen is bouncing from. Does everyone understand the importance of what's going on here? You're seeing it live. This is a live chart. This is the US dollar Japanese yen spot chart. So if it's going to be here, can somebody tell me what directional move it can go to right now?
Should be go up.
Exactly. I will put, if I was a currency trader, I would put some serious money at these levels where we are. And I'm going to draw a line. Let me try to enhance this. Now, who said we should go up? Who was that?
Me, Tim.
Okay. You realize that this is the inverse. This is the US dollar versus the Japanese yen. So what does going higher mean? If the yen goes to, let's say, 107 on the top of the channel, Tim, what does that mean? The yen is weakening or strengthening?
The dollar is going up and the yen going down.
Right. Because this is the exchange rate, right? Simple.
Yes.
Yeah, a lot of traders still screw up. It's a very simple thing, but they still can't figure this out in their head, even though I've explained it like 900 zillion times. Is the fact that when you see the yen up at 109, it's not strengthening, it's weakening versus the US dollar, because this is the inverse correlation. You get it? That's like an exchange rate. So saying all that, let me draw another line here, and you'll see how well these things match. The screen is shaking. It's like heavy duty stuff is going on there. There's a lot of data coming. That's when the screen shakes, I think. You know. Okay, so let's do this and show everyone the magic of technical analysis. And I am no currency trader. I use it as a proxy to understand what's happening in front. So if this is the case, yes, we can slip it maybe a little bit more. This little green shoot that's appearing might just get snuffed out, and we could fall and test the lower end of the band. I mean, sorry, the double bottom. This was a massive yen spike. This happened during Brexit, just so you know. So here is your couple of lowered levels. Now look, I'm not doing this to make everyone's a specialist in Japanese yen. I'm just simply doing this so you can see that if the yen can easily slip below 100 and go to 99, I can assure you markets won't like that short term. If the yen breaks the support at 100, you generally get two things happen. Markets freak out, even if it's for a day, whatever, and the Japanese government, the Bank of Japan, intervenes in the currency markets. And intervention is the scariest thing for shorters. If somebody is basically shorting the yen, expecting it to basically go, strengthen against the US dollar, and then the Japanese government intervenes and sells yen in the market, it is a very dangerous thing. The yen just spikes like this, like that. And that's great for, risk markets, which is stocks. Just want everyone to be clear about that. So this is the way I draw this chart, and this is where I think the yen is going over the next couple of weeks, which is good. Right there. It's a pretty defined pattern symmetry. Right there, right here, around 107. I would say that that the yen has a violent bounce. Why do I say that? Every action has an equal and opposite reaction. Every action. So the violence on the downside is going to be met with some ferocious move on the upside. In other words, the yen is going to weaken very fast, very quick over this week. That's my opinion. That's one scenario. The other scenario, so it's just going to basically move up real fast, like that. Or it's going to come down which is not a good thing for the markets, just so you know. At that point, decoupling and stuff doesn't matter. The markets are going to get really nervous. And if it comes down and tests these historical lows. All right. So the bottom line is we don't know which way, but so far it looks like it's holding the channel, but expect a slippage. Don't want to get into this too much because then, you know, we're not currency traders here. It's just a proxy that we use against the market. Now, I am willing to, what time is it? 9? What time did we start? 7:30? See, it's already about an hour and a half. So I'm going to have a couple of minutes. I'll answer a couple of quick questions, but I've explained this is the first of the sessions. Can't do it all in one day, but my, this is what I wanted to do. 1 second. I wanted to show a couple of quick charts that I draw so that you all can I know you guys can all read them, but one second, my computer's a little bit slow today, maybe because of the webinar and stuff. I'm trying to do something on my other screen and it's taking a little bit longer.
Hey, Clue, while it's
go ahead.
While it's slow, I saw this week when Japan come out, they held rates, but it had a note. It said that they were buying ETFs.
Yes.
Why were they buying that?
Oh, because Japan has always said that they will support their markets, and instead of buying straight out stocks, they're buying stocks via the ETFs. So
you mean
they're physically
their own basket of goods?
They are buying ETFs, so they will buy ETFs in Japan. Correct. So in other words, they're propping up their markets by saying, hey, we're okay. Look, Japan is I don't want to sound terrible, but Japan is a dying country. If you guys understand a little bit about demographics, there are way too many. Japan is basically their population doesn't grow. Their population is on a shrinkage. In 50 years, if Japan doesn't create more babies or gets in solid skilled immigration into their country, they're finished as a world power. Just the way any nation eventually dies when the population shrinks. Okay? So Japan is in a very difficult stage. Even though they're prosperous, they're rich, they're prosperous, things are expensive. So Japan is a huge pension fund. And they got to take care of their old people. And it's an aging country, not a dying country. It's an aging country. You know, in Japan, they rent grandkids, you know, because nobody has kids anymore. I don't know what the hell they do. They play Pokemon all the time. They don't have kids. Nations which refuse to have kids eventually die. So you know that. History has clearly shown that. So the point is, Japan's government is always promoting, you know, Singapore's the same way. It's a brilliant city-state. I've been there. It's so advanced. It's great people. It's so clean you can eat off the frigging street. They're smart, the most educated workforce in the world. Of course, it's a city-state. What, 2 million people? They got a lot of skilled immigrants and stuff working there too. But the point is, it's also another aging/dying state. Singapore pays young millennials, their type of millennials, 20s and 30s, okay? Thousands of dollars to go, date, get married, have kids. Japan has the same type of program. So what's happening in Japan is the reason they're buying the ETFs and stuff, their pension funds, their big government bond funds, pension funds, which are obligated to pay pensions, have to do something to make money. That's the reason why they're buying their ETFs. At one point, they're going to buy their own stocks too. And Japan can come out in the world markets and buy our ETFs too. Japan has a lot of foreign currency reserves, all right? Just so you understand that. So they're doing all this stuff because they need a higher level of return on their investment portfolios to pay their aging population. And if Japan doesn't have, if Japan doesn't turn around this demographic time bomb, that's what it is. Just like Singapore, but Japan in a bigger way. Nations which prosper and grow, like India, like China, the population is expanding. India has some of the youngest population in the world, as in demographic-wise. Well educated. And you see how, does anyone have an idea what India's GDP is? I mean, GDP growth rate is? GDP, yeah? Have any idea? Don't Google it, just tell me.
It's about 7-8%.
Correct. Thank you, Corey. 7-8%. Whoa. That beats the heck out of China. China's struggling at 6%. So I'm telling you, it's pretty big out there. So anyway, the bottom line is that populations have to increase in order for economies to flourish. So Japan is doing that. One of the reasons they're buying ETFs is because they want to prop up not just their markets, they'll buy ETFs overseas too. They want to get a higher rate of return on their pension funds. So that's it. Now, any other quick question, please? Yeah, Tim is saying gold up, and I think, yes, absolutely gold slightly down right now. Let me show you a gold chart. Good point you brought out. It's a definite bullish formation. I mean, this is a daily chart of gold. And the best ways to play it for aggressive players are NUGT and JNUG, JNUG. All the GDX, those things are, they're like small. These ones are 30, 15, 12, $13 movers. I mean, I don't really track, I mean, I track it, but I'm going to start recommending them, but they're very aggressive. The one that I had on my screen from a week ago, from Fed Day actually, when I started to see gold moving. Why is gold moving? Very simple, because currencies are being, currencies are overall declining in value, right? And the more central governments intervene in the markets by liquidity measures and stuff, right or wrong, like Japan is at this point, you are going to see gold and precious metals go higher. So NUGT, I had the July 29th on my screen. I didn't have it myself, won't lie. Okay, I wanted to buy it. It was up $13 just on Friday alone. These were the July 29th 137 calls. Now, why did I have 137? It's because that's what I was marking on Fed Day. From 137, it has gone to 160. And this is the chart that I was looking at. So get ready for it, all right? Oh, come on. So what I did was I did this. And this is a very powerful chart, by the way. I was doing this on the background. So on Fed Day, oh no, what am I doing JNUG for? I was doing NUGT. There, it's already drawn. So you know I wasn't BSing. So this was around Fed Day. It was around this level. And looking at the channel and the way things were moving, it was a high probability bet. Come on. It was a high probability bet that actually I was doing like this. Okay. This is the chart I was looking at. It was a high probability bet. It was around this level. Sorry. It was around here, I believe. Yeah. That it was going to hit the upper end of the scale. Well, not only did it hit the upper end, it went straight into this trading band. Remember, this was a trading band that NUGT was traveling in for quite a few weeks. I mean, days. From the 6th of, from the 5th of July till it broke down below it, which was the 20th of July. The trading band on the nugget was 144 to 168, 24 points, okay? Then it broke loose. So in that point, I drew a consolidation channel. The consolidation channel, look how good these technicals are working on this particular asset class. You have the 34 retest, jump. You have the 50 retest here, almost, jump. Now it's broken out of this channel. It's a given that it's going to go to 170. So right now, another 10 points is built in immediately. Now, once it hits 170, is it going to be all over? No. I think it's going to break out. And I think that NUGT is going to go to $180 to $200. Now, why do I say that? One way you can measure, and this is the last thing I'll talk about tonight because I need some sleep, is is you see that you measure the cup. You can do that with stocks too. You measure the cup. Some of you might know this thing. This is 160. I'm rounding off the numbers. What's the lower end of this?
120, roughly.
Yes, 120. Thank you. Thank you so much. So 120. All right. So 120 and you got 165, right? So how many points? What's the depth of the cup?
45.
45. Excellent. Now, what you do is you draw this is around 164. You add 45 to it. So what's 164 and 45? 210.
Right, roughly.
Roughly. Write that down today and see what happens in a few weeks. This frigging monster is going to 210. Because once you get a massive cup breakout of this magnitude, okay, of this magnitude, you will, not in a straight line, it doesn't go on in a straight line. Some days you have down days and stuff. But once you get a cup breakout of this line, there are a couple of things that can happen. We can create a handle, cup and handle. So the real optimal buy point for this should be around 142, which is the lower end of the channel. It creates a handle to 142. For whatever reason, one day you see it down 15. And I'll be watching this. I'll put this up as one of our trading things. It's for aggressive traders, though, because these things move, right? So you can buy a small amount of shares and say, okay, treat it like a stock. You don't have to play the options all the time. So bottom line is that it comes to the sort of the most favorable buy point should be around 142. Creates a handle, cup, handle, and then a big breakout. And that breakout will will come in the form of this channel, like that. And then it's going to zigzag its way up to 200 plus. That's my opinion. I don't think gold's coming down. Okay, it's no longer being used as a safe haven asset. It's used as a depository against possible inflationary pressures building up because of weakened currencies. That's it. So Nugget is on the table. JNUG moves bigger than Nugget. I mean, it's crazy. Look at this move. It would.
Can I bring up a point?
Yes, of course.
When whoever come in as a president, they will spend a lot of money to
Yes.
create jobs. So
Yeah.
gold will going higher.
There you go. Great point. Yeah, whichever, whether it's Clinton, whether it's Trump, they're both big spenders. Clinton's plan, Trump's plan is huge infrastructure. I mean, he's going to be, look, Clinton's, one of the reasons Trump's so popular, other than the fact that he's, he hit the right nerve with a huge number of dissatisfied voters, is that he is he's part Democrat with his actual economic policies. He's not a true Republican. Why do you think a lot of Republicans don't like him? Because he's got fiscal policies which are equal, if not more, in spending, government spending, to boost the U.S. economy. So whichever way, the markets will like it, like Tim said. You got it? He's not a fiscal conservative. He's going to, the deficit is going to balloon under Mr. Trump and under Clinton, which we already know because she's the extension of Obama. So the point is that and I'm not talking good, bad, or anything. I'm giving you actual economic stuff. That's the best way to do it, okay? So economically speaking, they're both going to balloon the U.S. deficit. And the hardcore Republicans who basically want to control the deficit are going to be like, holy shit, there goes our dream of a balanced budget. There ain't going to be any balanced budget. Okay? Now, most Americans don't understand that. They think that Trump is some sort of fiscal conservative and this and that. No, he's a big spender. Look, I'm from New York. A long time ago in one of the firms I worked for, his CFO was there begging money to save his casinos. He did a terrible job in Jersey, by the way, in Atlantic City. Terrible. I mean, from a business perspective, I mean, he's very smart. That's why he got off with it. Other people would be just done. So they were basically presenting us with, I knew his name, I forget the gentleman's name. Very nice guy. His CFO at that time. they raised at that time he raised a lot of money from Wall Street investors. So he came to different firms, for the presentations and stuff, and we brought it to our clients, and some bought the paper, as we call it, got the money. It still didn't work. They all lost their money. They all lost their money, seriously. He's the worst guy. That the next time, my boss, and this is a big name firm, so I'm not going to name any names. My boss was like, this guy is never even freaking coming through my door, because he burnt a lot of people. I'm talking about from the investing side. Trump stock was pushed by so many chop shops on Wall Street. I'm not even telling you. Real bucket shops used to push. What was the symbol of Trump stock? I forget. And it is the worst thing, the worst investment ever anyone can make. So he wasn't investor friendly. I'll tell you that. When it came to that part of his business, he never really made anyone real money other than the partners and stuff when it comes to real estate. And I'm being very objective. So the point is that he comes to power. Initially, the markets are going to rally. Then it's going to be a different story. I don't know what's going to happen after that, because our deficit is going to balloon like boom, because so much money is going to be spent initially. You get it? Just to remember that. Great for markets. Markets love spending. They might scream and shout about fiscal conservative, policies, tight control. No. Financial markets like government spending. Don't let anyone tell you otherwise. Okay? So all this business about managing your budget and not doing this stuff, it's all garbage. Financial markets, believe it or not, like deficits. Borrow and spend. They like that. But U.S. companies in general don't borrow and spend that much, as we know. They have huge cash levels. They're in good shape. But in general, financial markets like spending. Never fool yourself. All right? So that's it. End of story. Saying all that, we covered a lot of stuff. Thank you for attending. Tell your friends to come join us. Like I said, that's my sales pitch to you guys. And bring them in. I got to attend to some family stuff right now. It's 9:20. I'll see you guys first thing tomorrow. Let's have a great week, but trade with both eyes open. You have a little flavor on how my charts and stuff are shaping up. Keep on working on them. I'll be doing the ACS again, and I might not have wait till the end of next week. I might do one during the weekday, later in the evening. I might actually just do that. Okay. But thank you for attending. I appreciate it. This will be uploaded on the YouTube channel, and tomorrow morning, let me know, and I'll actually go ahead and add your emails to that, so you'll be all good to go. Thanks for
Thanks, Frank.
listening. Thank you. Bye.
Thank
Bye,
you.
Peter.
You have a good night.
You too.